Welcome to today's town hall for the Heliogenic Civilization, where we explore infrastructures of generosity towards Heliogenic civilization. And today with Graham and Greg joining us here, and they're helping us get into thinking in new ways about how to allocate money in a coherent way than we have thought about earlier, before. But I'm not the right one to introduce how that works. They're going to present, and then there's a live action game that we're playing. And as usual, we're recording the session. So if you feel shy about that, switch off your video, but we prefer to have your video on so that we actually know that there are other humans in the room. And yeah, having said that, I'd like to hand over the stage to Graham and Greg. Welcome. Thank you for being here.
Wonderful. Thank you, Thomas. Thank you for hosting us. I'm going to switch over to screen sharing. So what Greg and I are going to be talking to you about is a better way of investing and a better way of running businesses in an inherently volatile and uncertain world. And it's an approach which is named Ergodic Ecosystem Investing as against portfolio investing. And what we're going to do in a moment is use the latest version of our simulation to really experience the difference between what happens in a typical portfolio-based investment strategy versus exactly the same companies, but running under an ergodic ecosystem strategy. So first of all, a couple of things about myself. I was born in Africa, grew up in South Africa, started my life as a particle physicist, hence the Feynman diagram on the lower right of the screen. Then worked for Procter & Gamble for a number of years, left P&G in 2008, frustrated at how slowly even for-purpose companies like P&G were at recognizing just how severe climate change was already becoming in the early 2000s, and the absolute imperative to do everything we possibly could to address it, because even in the early 2000s, it was painfully clear that there was no time left. So left Procter & Gamble frustrated and asking myself, why is it that so many good people in so many good companies end up consistently doing things that we all know are not healthy for humanity and for life on Earth over the coming decades? And so that's what's been driving me for a couple of decades now, trying to figure that out. And for 16 years now, since leaving P&G, this has been my focus. And what we're doing here is, in many senses, one of the most powerful answers that we've come to of what can we still do. So that's a bit about me. Who's Greg?
Well, so this is me. I'll quickly run through a pretty standard sort of bio in about 30 seconds. So Cambridge University economics, a number of years ago now, followed by Bank of England, and that was for about 10 years. The last job at the bank was basically helping to manage the bank's own pension fund. I then switched to a macro hedge fund where I was a macro strategist. So I've seen both the sort of conventional vanilla asset management, but also alternative in the form of a macro hedge fund. I'm guessing most of you will probably know what a CFA is. I'm a CFA charter holder. For those who don't know, that's basically a master's degree in practical asset management. After that, after the hedge fund, I was chief economist at a think tank for a little while. So my orientation's been around economics pretty much my whole career. And then I took some time out to do a PhD in complexity economics, and I will come on to explain what complexity science is. The last thing really to say is that all this sounds rather kind of standard and orthodox, but actually I'm very much heterodox. The way we're running the world is just barking mad, and we need to change that. So that's my bio. Thank you.
Wonderful. Thank you, Greg. Yeah, and there are lots of things Greg and I agree on, and the fact that the way we're running the world at the moment is barking mad is something we definitely agree on. So now to jump in. Everybody knows the success factors for business. Some of them include product market fit, excellent execution, that a company is never outcompeted, that it always has sufficient runway or working capital, and that it has a sufficiently healthy and sufficiently smooth cash flow. If any of these are not quite there for an individual business, then the business is quite likely not to be around in 12 months' time. However, there's a question mark behind all of this, which is, are these causes or are these causes of success? And if they're not present, causes of failure, to what extent are they the deepest level root causes versus intermediate proximate causes that have some other deeper level root cause? And that's what we're going to be diving into now. And without any further ado, it's time to jump into the game. So we'll split up. I think with this size group, we'll split up into 2 separate funds. And each fund is competing with the other funds to do the best possible job to preserve and grow the money that your limited partners have invested in you. There are 20 companies that are seeking investment or that you can invest in. Choose at least 10 of them for your portfolio and allocate the percentage of your fund that you'll invest in each company. And the parameters that we're imposing is a minimum of 5%, a maximum of 15%, and all of your fund has to be invested. You're not allowed to do what Warren Buffett does and keep a significant fraction of your cash as dry powder for opportunities that might emerge next year. Everything has to be invested between 5 and 15%, at least 10 companies to be chosen, and you can choose up to 15. So let me just pause there.
Okay, can you guys see my screen?
Yep.
Great stuff. Okay, so we've got we've actually got 8 portfolios, but it's between the teams. So team 0 is actually the portfolio where everything gets 5% weight, and then we've got team 1 and team 2, and then team 3 is just another random portfolio. So, and the solid line is the Ergodic counterpart, and the dashed line is the conventional portfolio. And this is after year 1. So we have, let me see if I can see the colors. Team 2 are ahead, and it is followed by team 1, followed by team 0, which is the portfolio that has a spread portfolio, even weights, and then you've got the last one at the bottom. So I'm going to zoom forward. So that's the end of the first year. Let me minimize the screen. We'll move it out of the way. Okay, so this is year 2. And what we've got there is there have been some liquidations. A couple of the companies, one of them, 1 second, not for the faint-hearted. The company has gone insolvent during this year, unfortunately. So that is why there's such a decline in returns in 2 of the portfolios. So what I'm going to do now is go to the next year. So that's the end of year 2. And this is the end of year 1. End of year 3. And then we'll carry on. And this is the end of year 4. So we have the 2 Ergodic portfolios up here are the sort of high performing ones. So that curiously, that's team 1 and team 2's Ergodic equivalent portfolios, which is slightly outperforming the conventional portfolio. And now we actually have the team 0, the evenly spread portfolio, is actually outperforming. Now it's winning. So we have 3 Ergodic portfolios doing well. Here we are. So this is the next year. There we are. So this is year 7. So again, this is the evenly spread portfolio. Here we go. This is the end of year 8, end of year 9. And finally, this is the final chart. So we have the three ergodic portfolios up here have outperformed. One of the interesting things, which is incredibly low probability and well done to team 2, is that your portfolio, the conventional portfolio, outperformed the non-ergodic portfolio. And I know from having tested it, there's about a 4% chance of that happening. So well done you. I'll pass this back to Graham.
Thank you. Could you keep the slides up there?
Yeah.
So a couple of things I just want to point out is that apart from team 2, which did something, as Greg says, highly unusual, the ergodic ecosystems are typically outperforming the portfolio, the conventional portfolio approach to investing. And as more time passes, it becomes more and more telling. In particular, if I look at team 3 or team 0, both of which were our reference portfolios, the ergodic ecosystem of even the worst performing ergodic strategy is outperforming the best performing conventional portfolio. Yeah. And so this is one of the key messages to take home from this. An ergodic ecosystem is, first of all, significantly less sensitive to the shocks where a company goes bankrupt or something like that, basically because healthy companies typically don't go bankrupt. So you see in the ergodic ecosystem where those shocks were happening, the ergodic ecosystem is not being hammered by a shock. What you're also seeing in the green team 2, none of the companies chosen actually had a shock. And that's at the heart of why there's insignificant difference between the conventional portfolio and the ergodic ecosystem for team 2. However, much as it might not be nice for team 2 to hear this, the fact that none of those companies experienced a marketing shock or COVID-19 shock or anything like that was not because they have the gift of God to predict at investment day the next 10 years of all unpredictables. Yeah. And this is another one of the key messages here. There's so much of what is attributed to the skill of the investor, which the more you dive into the non-ergodic dynamics of capital becomes clearly a consequence of hitting it lucky. And this is one of the reasons why big funds tend to outperform small funds in a game of numbers, where you have a very rare unicorn that makes the entire fund, that pays the entire fund. The chance of having a unicorn increases simply by numbers. If you're investing in 100 companies, the chances of having the unicorn that pays the whole fund for all 100 companies is just higher than if you're a specialist fund only investing in 5 or 10 companies. So I'll say a couple more things, and then, no, given the group of people who are here in the room, let me move to questions and answers. And Tanuja has raised a hand. Tanuja.
Yeah, thanks, Graham. So it seems that the liquidation events did not hit either team 1 or team 2, simply because of the companies we had chosen. Is that correct?
I couldn't quite hear the question. I'm finding your microphone is not very clear. Could you repeat?
It seems from the diagram that the liquidation events, the shocks, did not touch either team 1 or team 2. And that's simply because of the funds that we selected. Is that right? the
Yeah.
companies that we select.
Yes.
Yes.
And the blue line, it has this huge curve upwards. Why is it that it has such a difference from the black line? It seems to me that the liquidation events are the same companies in both blue and black teams.
So the things to compare, on the one hand, the blue and black dotted portfolio lines where the liquidation event did happen, whereas in the ergodic ecosystem, the solid blue and the solid black lines, the liquidation events did not happen. And that's a big part of the difference. Greg, am I correct in saying in the actual simulation, the liquidation events did not happen in the pooled
Yes.
ecosystem?
Yeah, absolutely. It's worth reiterating that the portfolio companies made a single pool, and the blue line is all 20 companies in a larger pool. Okay, so in fact, if you look at these lines, you can kind of differentiate between two effects. One is the steps, which you pointed out, the liquidation events. But in general, the solid lines are kind of the blue and black in particular, generally steeper, even if you exclude the events, which I think is essentially about a greater efficient use of capital at the ecosystem level. And that's me done.
Yes. And also, for those who recall the graphs from my book, the pooling also smooth out significantly the idiosyncratic month-to-month volatility in sales volume. In other words, volatility that doesn't have any cause behind it, but is just some months people buy more, some months people buy less. And the business has no way of predicting that at the beginning of the month, because it's up to the vagaries of people. If you're an ice cream company and the weather's hot, you'll sell more, except in Germany, where if you're an ice cream company and the weather's cold, you'll sell more. Harry, you have a question.
Okay, so with the caveat that while we've had conversations, I have not read your book, and I'm still wrestling with trying to get my head around what is ergodicity. So I see the point you're trying to make here with this blue line, but I'm not sure what's actually the math behind that. So I guess it would be helpful for me to understand, like, what are the characteristics of said portfolio that actually, make this, develop this huge delta for the blue line. Is it an evenness of distribution of capital?
Let me dive into that, and you need to leave in 2 minutes.
Yeah, so maybe it's a TBC, and I don't want to take up airspace if other people have,
Yes. Let me give you a very quick explanation. So the central message is that the statistics used to construct portfolios are the wrong statistics to use in an unpredictable, volatile world.
Got that.
When you use the right statistics, what you see very clearly is that the best thing to do is the strategy that nature has used for 3.7 billion years to thrive, which is a blend of competition and hard collaboration, where hard collaboration is that a certain percentage of the profit of each company is pooled, and that pool is then redistributed to each company every month. This is what professional poker players use as a syndicate, that everybody stays in the game. And it's something where if there's no unpredictability, you get exactly the same number with or without pooling. And the bigger the unpredictability, this ends up giving each company a double-sided hedge. It's a hedge against black swan events.
Right.
And it's a hedge for white swan events, because the ecosystem always has enough capital, or the maximum amount of capital, to grab opportunities when they come.
Right. That's helpful.
And in this particular simulation, to maximize the signal, we've put it at 100% profit pooling. Realistically, you'd probably run it somewhere between 10 and 30% profit pooling in real life.
Okay. Okay. I feel like I've had a breakthrough. So thank you. I've got a ways to go, but I look forward to seeing you all again, and thank you for including me.
Wonderful. Thank you, Carrie.
Good to meet you.
So perhaps Thomas, how are we doing for time? Shall I go through a few more slides? What's your sense?
Unless there are more questions, and I would say you can continue with the slides. Yes. So show of hands. Who has a pressing question, or who would? So Donna, you would.
My
oh,
question.
you raise your
I-
hand already.
My question can wait. I mean, I want to make some observations about the implications of this, and so Graham, go ahead with slides. But to the extent that some people can hang in, I'm very interested in where we go forward with some of this. So go ahead.
Right. Okie do.
Okay.
So everybody can currently see an infinite recursion.
Yeah.
And ought to now be able to see my slideshow. Right. So we've had the Battle of the Funds. We've seen who the winner is, which is the Ergodic Ecosystem Reference Fund. And the central question for investors then is, how good is an investment strategy? And in particular, does an investment strategy have the best possible product market fit? And what we're pointing at here is that in a world that is highly non-ergodic, the conventional portfolio approach to investing actually has a less good product market fit than an ergodic ecosystem. And the fit gets worse the higher the volatility. And it's all coming down to, for a long time in medicine, for example, before people understood about bacteria and viruses and so on, the root causes of diseases are now what we would recognize as a proximate cause, rather than the virus or the bacterium as the root cause. And similarly here, typically the reason why businesses go down is because they don't have enough working capital left. And the root cause that's often pointed at is a bad marketing, or the Suez Canal was closed, or COVID-19. In other words, something that was not predicted. And that might be attributed to, as a root cause, the management or the strategy or whatever not being good enough. And that may be true, but in far more cases than is currently recognized, because we're using the wrong statistics, it's because the overarching investment strategy itself is neglecting path dependency, non-ergodicity, which becomes more and more important the more volatile and uncertain the world becomes. So in essence, the way that we're building business plans, the statistics we're taught to use, we build business plans that cannot see clearly, cannot use the most powerful strategy, and are yielding false real-world navigation, as I said, because the equations are for a fantasy world, an ergodic world where history and the path, etc., doesn't matter. And as I mentioned, the ultimate strategy, the one that nature's used for 3.7 billion years, is one that has an admixture of collaboration and competition with profit pooling. And in a natural world, this is, as you can see it, putting glass tanks next to each other doesn't make a coral reef. Putting 10,000 trees, each into their own individual pot, doesn't make a forest. To make a really anti-fragile, flourishing forest, you need to have all of the roots intermingling and the mycelium exchanging the natural capital between all of the trees. And so the central conclusion of this is that a portfolio strategy is investing in single isolated companies and then trying to do all of the magic by choosing which single isolated company to invest in. And what we're seeing here is that when there are shocks in the system, when there's unpredictability, volatility, uncertainty, and the more of that there is, the more an ergodic ecosystem strategy outperforms the single isolated company portfolio strategy. And as John Fullerton asked me quite a few months ago, as he was getting to understand this, he said, "Graham, are you telling me that it's dumb to invest in single companies?" And I said, "Yes, John, absolutely. It is dumb to invest in single companies." And for me, this is a reason for hope in the face of climate change. I'm not going to go into more detail on this one. Most of you have seen these graphs already. And this just gives an illustration of, if you have 0% profit pooling in this simulation versus 1% versus 10% versus 100%. So you see how much more powerful 100% profit pooling is than nothing. But even 10% already gets you pretty close to the maximum. And so that's why I was saying earlier that in real life, you'll probably want to sit between 10 and 30% profit pooling, because competition also has some key benefits. You absolutely do not want to eliminate competition. It's healthy, it's necessary. At the same time, neoclassical economics has, because of its ignorance of non-ergodic dynamics, has led us into a fantasy world where there's this myth that pure competition is the solution to everything and the market will fix everything through pure competition. So that's kind of hot off the press. The myth, as I said, is that competition is the winning strategy and collaboration must be explained. And this is very strongly linked, by the way, to things like multi-level selection. We need multi-level economic strategies that have higher collaboration, say, at one level, and higher competition at the next level up. And it's this blend of high competition to maximize anti-fragility and high collaboration to maximize anti-fragility. If we're sitting at, say, 70% competition and 70% collaboration, that really maximizes anti-fragility. So, Greg, over to you on complexity. Do you want me to run the slides or do you want to run them?
Yeah, you run the slides. It'd be just easier, I think, if you don't mind.
Okay.
Okay. So I just want to take a step back and really the key message here in the next sort of 3 slides is there is an enormous amount of academic research in the field of complexity science that supports what Graham just said. And the phrase I like to come back to is Stephen Hawking's phrase, which is, I think the next century will be the century of complexity, which he said in 2000. So complexity science, to discuss it briefly, is...
Graham, could you mute yourself because you're echoing for what Greg is saying?
Yeah, thank you. So complexity is a movement across academia with its roots kind of going back to the 1960s. A number of people see it as part of a new enlightenment, which is about interconnected dynamic thinking. And the important point to make about complexity is it's a terrible, terrible bloody name. People tend to be averse to complexity and uncertainty, so it's a horrible name. And what I've written here in the sort of 4th line is really what it's all about. It's the study of interconnected dynamic systems. Okay, and as the whole universe is just everything in the universe is in flow and is interconnected, it's relevant everywhere. Okay, so that's really what complexity science is about. And like I said, there's a huge amount of research, even to the extent there's now 2 schools of complexity science. One is called general complexity and the other one's restricted, which I won't go into in any detail. Graham, could you put the next slide, please? One of the things I like to do with complexity is to discuss it in the context of left brain and right brain. I'm particularly thinking of Ian McGilchrist's work here, which is just outstanding. Don, I'm really liking you nodding your head. I'm guessing you're familiar with a lot of this. So very much what Graham was talking about with neoclassical economics is very much a left brain view. And I'll mention what I mean by left brain in a second for those who are unfamiliar. And so complexity helps us move away from that machine-based view, which is the left brain, towards a more pattern-based and dynamic view of reality, which is what the right brain is about. So it's all about pattern recognition. And McGilchrist argues very convincingly in a lot of words that the right brain specializes in the whole picture, the whole context, and it sees the bigger picture, so it should be the master. Whereas the left brain simplifies things in order to get things done. It's important, but it shouldn't be the master, it should be the servant. Okay, so and McGilchrist's main thesis is the whole world is built around the left brain, the machine-based view of reality, and how our economic and political systems are designed with that point of view. And my PhD thesis focused on the right brain aspects of economics, you might say, which is on social norms, conventions, and laws as patterns within economic systems. Graham, thank you. So why is this relevant to asset management? Well, it's incredibly relevant to asset management. As you saw earlier, my background is very much sort of bread and butter is asset management. So in asset management, the academic theory is poor, to say the least. There's some bits and pieces that's very good, but most of it is very poor. And also the conventional approach. Recall I did my CFA studies in conventional asset management. That's also based on a machine view of the world, which is the left brain. And so complexity leads to a very different perspective in economics and finance. One of the concepts I've been developing is this idea of complexity arbitrage. There are huge opportunities here in applying the complexity right brain view of the world, because market prices currently reflect, largely speaking, a left brain view. Okay, the right brain view is much better at grasping how the system works. And if you develop a right brain view or a balanced brain view of financial markets and economic systems, you should be able to make some money. So a couple of themes here in terms of complexity and asset management is there's an emphasis in risk management in asset management. And I would distinguish between risk and uncertainty. Risk is very much a left brain view again, and uncertainty is very much a right brain sort of humble view. So the question I ask is, shouldn't we have an uncertainty management function in asset management rather than a risk management function? Risk is very much the orientation of the insurance industry, whereas asset management is inherently about uncertainty. And the second theme is actually what we're talking about here, which is the distinction between ergodic and non-ergodic sort of views. The non-ergodic view is very much the sort of right brain view, as in this is how the system works in reality. And that's what we're focused on here. That's it. Any thoughts and questions on that? I'm happy to field.
Yeah, I do actually, because I'm wondering what are some, so diversity is good in a portfolio. So the question is, what are some relevant and measurable dimensions of diversity that you see are at the foundation of this? So is diversity in industry relevant, or is diversity in regionality maybe relevant? So that would I would be very curious about.
Graham, did you want to field this one? Because it's more of an ergodicity issue. Oh, you're on mute. Yeah. Which you
right, off mute. So the central principle is that the more the different companies are counter-cyclic in their response to a given shock, the closer you can come to anti-fragility, and the higher the percentage of profit pooling between companies. As an ecosystem, the closer you come to anti-fragility. So if you're on a portfolio strategy where there's no profit pooling at all, in other words, you're following you're completely subject to the non-ergodic dynamics of capital. You're not using any strategy. Oh, somebody's leaving?
Oh.
Right. Okay.
Okay.
In other words, you're completely exposed to, you're using what I would call a 100% non-ergodic strategy. In other words, you're not at all correcting for the losses caused by non-ergodicity in your portfolio. The more diverse it is, the more chance you have of your portfolio surviving. However, you're still exposed to the maximum risk of any company going down and going bankrupt. And that means diverse industries, diverse geographies. Like if the US economy goes down and the European economy is going up, you're better off if you have companies in each economy. And then if you shift gear and you move into an ergodic ecosystem where you do have profit pooling, you then ramp up another stage even higher. And this kind of ergodic strategy with a large enough pool of a large enough ecosystem of companies, sufficient profit pooling, and sufficient diversity, you can get back to the upper ergodic limit. In other words, you can go, that gives you the ability to go as far as feasibly can be done for all of the different kinds of uncertainties to cancel each other out, and the entire ecosystem to have high levels of certainty at an ecosystem level, even though any individual player is still subject to maximum uncertainty. And the last thing I'll say on that is where you can see this being played out year in, year out, is if you look at any of the big multinationals with multiple fundamentally different product categories, like a Siemens in Germany, or like a Procter & Gamble in the US. They're active in almost all of the countries in the world. They have products in so many different domains, and they have 100% capital pooling across all of their product lines. So that's a perfect ergodic ecosystem. Check.
Thank you very much. Who would like to ask something? Greg or
Donna,
Graham?
you've been patiently waiting, and then Tanuja.
Tanuja, go ahead.
All right, thanks. So Graham, thank you for that that example of the very large conglomerates, because that makes complete sense as to their strategy. Yeah. So I have a slightly different question, and this question is about the commons. Could we see the commons? Is it possible from a theory perspective to see the commons as a pool? And then when you talk about 1%, 10%, whatever pooling, if the profits, let's imagine a scenario, bioregionally focused companies, and their pooling supports the commons, which is water and everything else. Could that be a way for us to envisage protecting nature?
Yeah, actually, can I take that, Graham? Well, maybe have a think of it, because my PhD thesis was very well partly on Ellen Ostrom's work and also Douglas North's work on institutions. Yeah, so commons is typically thought of as a resource, but you can absolutely build a pool around it. Okay, so the people who are stakeholders in the commons and could build a pool that corresponds to the commons. Graham, do you have any thoughts?
Yeah, I'll build on what you're saying. So this is what we've just been showing you in terms of ergodic versus non-ergodic investment strategies is exactly why we developed the Fair Shares Commons Incorporation starting nearly 15 years ago. Because to govern a profit pooling mechanism effectively requires each company to be itself a commons, the pool as a whole to be structured from a governance and a wealth sharing and benefit level as a commons. Anything less than a Fair Shares Commons especially if it's a standard limited company, is just from a governance perspective too weak. It has too many Achilles heels to be a viable legal foundation for such a profit pooling mechanism. And in that sense, in my use of language, also I distinguish between a commons versus the commons. The only thing I would refer to as the commons is the entire planet, all of the water, all of the atmosphere, everything. That is the commons. Everything that is at a smaller scale as that, say a bioregional ecosystem, that is a commons rather than the commons, the one and only. And and so for this kind of, the way nature works, it has a hierarchy of commons of ever increasing scales until you get to the global commons. But even just a little depression, half a meter in diameter on the side of a mountain, can be its own microclimate, its own micro bioregion, and its own micro commons. And in that sense, as we look at business, the way we think of it is that every single human being is a commons. I'm a commons of all of my different cells and personalities and voices in my head. And the better I can govern myself as a commons, the better I can engage at work. All of the different staff in their interactions with each other, the culture that emerges, that is a commons of people. And again, the better we can govern that commons as a commons, the better the teams work together. And going upwards, you can look at the roles and tasks as a commons of roles and tasks, where sociocracy is a powerful way of governing that commons. If you use a fair shares commons legal form, then all of the capitals and stakeholders are visibly governed as a commons, and that enables the company to be governed as a commons. And you then use the same thing when you get to the entire fractional profit pooling ergodic ecosystem of companies. If that profit pooling mechanism is structured as a commons and governed as a commons, you have the best tools available to get the benefits of profit pooling and the benefits of competition. Check.
Yeah, thank you, Graham. I wanted to interject one more concept here. I'm not certain here, but I'm thinking of the commons as an emergent effect, an emergent property of the various systems. And so in that sense, the emergent property is unknown, but needs to be managed. Yeah. So Greg, complexity is also something I do. That's sort of my thing. I think that of all the different properties of complex systems, the three perhaps, that need to be highlighted and incorporated in a day-to-day way are emergent properties, self-organization, and tipping points. Yeah. So at the moment, tipping points are seen as black swan, as you mentioned, and being seen as rare and undesirable. But in complex systems, tipping points are normal way of movement.
Yes. And the one thing to build into that, this is why neoclassical economics has done so much harm, coming from a paradigm of Newtonian, not only Newtonian, but ignorance of complexity, because it builds structures that shut off all possibility of positive tipping points and increase the sensitivity of the system to negative tipping points by having a religion that rejects strictly all forms of collaboration, when that's at the heart of how nature harnesses positive tipping points and emergence.
Yeah, I would add to this that, coming back to the left brain issue, is that neoclassical economics It's heavily left brain, so it atomizes the whole universe, or atomizes the economy into small parts, and the whole is then viewed as the part. But what they don't understand, what they don't see, is the right brain stuff, how everything's interconnected, and how fit patterns emerge in the whole system, which need to be understood, and which need to be harnessed when they're valuable. And we destroy these things without realizing it, because we don't actually see them a lot of the time. All the social capitals like that. And once you see the interconnectivity of things, to me, the ergodic ecosystem view is equivalent to like a mutual insurance. It's basically saying that we're kind of like, all the individual kind of parts are kind of being damaged in various ways, could be damaged in various ways, but actually mutual insurance helps the whole, right? And it just helps the whole work. And if you think that actually that mutual insurance is really valuable to all the parts of the system, it stops them from, for example, going into liquidation and wasting enormous amounts of capital, right? Then that waste of capital doesn't happen within the ecosystem level. So the other, very quickly on this, the other image I have in my head is basically a pack of wolves, right? Individual wolves can go hunting, right? And they might catch something. But if you've got 10 wolves hunting in a pack, often they'll actually get more than 10 times what an individual a wolf will be able to capture. But then imagine if one of those wolves was wounded, right? If it was hunting on its own, it's dead, right? If it's wounded in a pack of 10, it might take a week to get better, in which case it comes back and it's then a fully fledged member of the pack again. Okay, so this mutual insurance thing happens at that sort of level as well. Check.
Appreciate that, Greg, and it's spot on. And I'll just put in the one mirror thing. Think of this very much as a double-sided insurance or double-sided hedge. It's not just insuring against bad things happening and getting back to average. It's also enabling, as Greg pointed out, even better things happening, because you have all of the resources you need to tap into white swans. So it's a hedge against black swans and a hedge for white swans. Check.
Yeah.
Thank you. Donna, you still have a hand up. Is that a new question or?
Well, it was one I never really raised. I mean, there's an echo again, and I know we're at the bottom of the hour. There are so many threads now that we've touched on here, and I'm really glad, Greg, that you brought in the Ian McGilchrist's work around right and left brain, which I think is really important. My interest at this point has to do with the implications of when the penny drops and we really truly understand this. The ergodicity game is a way for investors in particular and some entrepreneurs to get their feet wet around understanding some of this stuff. As more and more investors play this game, there'll be more data that can be shared around it. Carrie's question touched on how investors are going to want to understand, wait a minute here, how is this done and what is this based? Like they'll be asking the detailed questions, I guess, about the math and the way that this stuff has been modeled. And so, I mean, the other thing that is striking me here is the order of change that this really does represent, and yet how powerful it is. So we've got, communities of conventional investors whose careers have been based on being capable investors that know what they're doing. And now here comes along this, the world isn't flat. This stuff has never been the best way to go. And the challenge of the learning that needs to happen to shift the game to this kind of regenerative economic model at the ecosystem layer. So it points to the need for more of that learning. And in ways, it brings us to the human side of all of this, of how to bring this into the world. And then the other implication around all of this touches on democracy in terms of new ways of functioning that in fact will enable us to better actualize what democracy is aspirationally intending to be. in the world. And so the strength of this increases as more and more and more and more of these nested ecosystems are nurtured and developed. The exponential potential of this continues to go up and up. And we all become less fragile when more organizations and ecosystems and people start to move in this direction, which is why we're feeling such a strong need to support it. So it's not really a question here, but it's having to do with, you know, and I know we've run out of time. There's the and person, right? But really, I would love for us to have further discussion around how we bring this into the world, like the multiple ways that we can bring this into the world and enable more of this kind of thinking to take flight. Check.
Thank you, Donna. Tanuja, you raised your hand.
Yes.
Together with
Question.
um,
Graham?
go Tanuja.
It's a question about responsibility. So we've been talking about investing in companies and portfolios, no matter how diverse. But the whole game of trading stock, there is a larger effect around what you have called e-commerce. What do we think about that? We've got trillions of dollars being traded per day. And the actual real companies that are at the base of all of this, what is the effect on them? It's like they're being pushed around.
Tanuja, I don't think you cut out a little bit. Your microphone's gets a bit weak at times. Would you mind repeating the question?
Oh, very sorry. Maybe I should just type it. My question is, we have trillions and trillions of dollars being traded every day. There, under every stock is an actual company with real people.
Yeah, could you
What
try?
is the
We can't
effect?
hear you.
Okay, sorry.
I think Tanuja, I know what you're getting at. I've had enough conversations with you. I think I can guess what you're pointing at. So I'll take a stab at answering it, and then Greg, you can add in and Tanuja comment if I've missed something. But I would say all of this trading is definitely an issue. The biggest part of that issue is not so much the trading per se, it's the fact that voting rights go with the trading. So this is the financialization of the whole economy, that the finance sector has governance power over all of the economy. That's really the issue, which is one reason why none of this is going to work until we've changed how companies are actually governed, that the voting rights are adequately shared out across all stakeholders, not just centered in the finance industry. That's at the heart of it. And yes, you're right. All of this trading is a big part of the problem. The financialization of the economy of capitalism is one of the root causes of what we're dealing with. So maybe that answers your question to some extent, Greg.
Yes, I'm not sure. I mean, I could talk for hours about this because I was in financial markets for a number of years and I was a regulator in the Bank of England. And actually one of my jobs in the bank was actually to go out into the financial markets and talk to people with a sort of regulator's hat on. So I've had that view. We just have to look at the 2008 financial crisis, Tanuja, to kind of, you know, think about what you're talking about. And it's an absolute disaster. But the thought that immediately came to mind when Graham was talking is that, and this very much links to what Donna said, which is the parasite here is the mindset, right? It's not so much the people, it's the left brain orientation. It's the mindset that goes with it. And we are killing the planet and we are, you know, ruining communities because we have a really bad mindset that doesn't account for the interconnected nature of reality. So yes, I completely agree with the sentiment of what you're saying. It does need to change. And what I think it's important to say, there's lots of different ways it can change. I'm open. So Graham is trying to, you know, valiantly create something afresh, you know, an ecosphere that actually kind of works in practice to show, because if you're transitioning from one paradigm to another, ideally you need something that sort of demonstrates it works, right? And that's fantastic that Graham's trying to get that going. Whereas there are other strategies as well, which I'm involved in, which is trying to change the system, right? Change the current system. So I'm currently in the middle of writing a white paper, for example, on the implications of complexity science for asset management. And some of the things I've discussed here sort of are going into that. But one of my strategies is to kind of just go and talk to the asset managers and tell them, actually, if you change your mindset, you can actually make more money in doing this. And I'd also just flag that there is one beautiful company, actually two beautiful companies that do have the right mindset, which is Baillie Gifford, based in Edinburgh. And they're a huge asset management fund. They trade something like 6 trades a year, and they have something like $200 billion, right? It gives you a sense of how different they are. And then you've got NZS Capital, based in Colorado as well, who are taking very much an explicit complexity science approach. So there are, and people I talk to are very keen to transition. And I've met a lot of people in finance that basically say, look, we want to change this thing. We want to kind of, we understand what you're saying, but we're basically guided by the shareholders, right? Or we're guided by a mindset that doesn't allow us to do this. That's it. Check.
Baillie Gifford.
Baillie Gifford. Yeah, Baillie. Baillie. Let me type it in.
Yeah. The other thing I'd put in to build on what Greg has just said, it's been a creeping downward spiral of the interplay between the mindset and then the structures, the institutions that we build around that mindset that then reinforce the mindset and take it even further down. And then we build structures and institutions to reinforce that. It's like that Churchill quote of, we shape our buildings and then our buildings shape us. And that's where Greg's strategy and Evolute 6's strategy complement each other, because we're both addressing different aspects of this vicious circle that keeps us spiraling ever further away from where we need to be. And that's why it's, I'm loving working with Greg, because he brings in a very complementary experience and perspective to mine. And that's why, to your point, Donna, that's why we're setting up this course specifically for investors that Greg and I will be running. And the first version of the course will be running in July. So, if you know any investors, asset managers, angel investors, advisors in the finance sector who are looking for a better way of doing things, do send them to that course. Yeah, and of course, there's Ergodicity 101 for everybody who wants to start to understand that.
Mm-hmm. And of course, I took the 101, which kind of opened up my eyes. I'm not an investor. I'll never be an investor. But what I'm appreciating here is that we're trying to find ways to create contexts, the enabling conditions that will enable us to break that pattern that you're talking about, that vicious circle. And by bringing in more of those investors and bringing their creativity and the ways, there will be more ways that we can bring this into the world by bringing more people into the thinking. And that's what I'm looking to in terms of collaborative creativity, is recognizing you alone can't do this, Graham. You alone can't do this, Greg. And there's other thinking. And then I think about what you're doing, Thomas, with the various things that you're involved in, bringing your particular lenses to this problem and opportunity, I think opens up some potential for us. And that's kind of where I'm excited and hopeful. Okay.
Thank you. Marie, do you have questions?
No, not really, but thank you for asking, Thomas. I've been working with Graham long enough where I've already assimilated all of this. We know it, we live it, we think it. No, just I'm actually more interested to understand the game as a product. And basically, because of everything that we've been saying, I mean, from what we know, investors their whole identity is literally constructed around this left brain thinking, right? I mean, their livelihood depends on that thinking. So yes, that's, I feel like it's a challenge, but okay, check.
Okay, so I think it was very, very interesting to see the real data points within the game. In terms of playing the game, there's some constructive criticism that I would like to add, which starts at maybe providing the information up front, building the funds up front, and asking people to finish them like a day before getting together, so that you also have time to run the calculations, so that this doesn't take away from the surprise at all, but it makes it more fluid, and it maybe even more compelling, because then people have actually put some thought into how they put together the fund. But seeing data on how ecosystems actually outperform groups of single players is very, very helpful. And I can only echo everybody else here that it should be adopted much more widely. I only want to point to 2050, the fund out of France, who are doing that, right? So they are looking at ecosystems and even going so far as to understanding that ecosystems don't only in the economic space even don't only consist of for-profit but also non-profit actors. So a portion of the fund is reserved for non-profit donations, which is highly unusual, right? So there are people out there doing this and providing the data background for people to really understand that this is not just an idea that Marie has come up with based on her track record of building funds, but this is actually how the world works. So thank you for doing that work. I will share the final recording. I'll edit out the pieces where we are in the breakouts and such, but I will share the video in the hope that some other people get to see that specific portion and understand, and maybe then join you in your course. Cool. Thank you so much, everybody, for pitching up and being
Great.
here today.